In this presentation, I am going to describe how you can make use of our intraday option calculator. This is one of the fantastic tool we have developed and it is present in our website from the past many years. In the 2009 onwards, it is there in our website. And if you access to this our calculator link and you can go to this intraday option trade software. So you will land in this particular calculator. This is one of the best calculator for intraday option traders. If you do not have any access to any of the paid option tools for making your intraday trade decision, you can rely on this particular tool and it is a highly accurate tool. I'm using the GAN method here, GAN angle principle here. I'm using the binomial option pricing model here, binomial option pricing model. I'm using the GAN method for making the trade decision here, and its accuracy is pretty good, and in percentage terms maybe 70 to 75% of accuracy you can get it. So here how you make use of this particular tool: current day's last traded price, or at current price, at what price it is trading now. Now currently at what price the future is trading, underlying future. Suppose if I am taking out the Nifty, so Nifty, if I can say, now I am recording it on the 5th of July 2016, and now market has already ended at around 4 o'clock 36 minute. I am recording this, and 4 o'clock 36 minute I am just recording this particular event on 5th of July 2016. So Nifty last traded is 8352. We have got it. So in a running market at 9:15 market opens, suppose if you are going to do the trade at 10 o'clock, at 10 o'clock what is the price? Now I am at 4 o'clock 36 minute, market closed. I am using the 436 price points. If you are using the calculator at 10 o'clock, at 11 o'clock, at that particular time, what is the Nifty future price? That you need to input first. This will be your first input. So I am putting that 8352 and day still expiry. So this you will be getting from your calculators, means expiry day. So this month of July 2016 we have expiry on 28th. We are at 5. So if I can reduce this 5 from the 28, so 23 days are left till expiry. 23 days are left till expiry. I am choosing any strike. So any kind of strike you can choose. I am using 8500 call option strike. Suppose I want to do the trade in the 8,000 means call option of 8500. So I have chosen that 8500 strike and the price reported here as 51.6. So in running market you will get one price which is the premium at which the option will be trading. That premium you will need to punch and you have to hit a calculate button. Once you hit these things, this particular method or this particular calculator will calculate the implied volatility, which is very important here. The implied volatility parameter which you will get in the NSE site. In NSE website, whatever the implied volatility you are getting, it is based on a historic fact and it is based on the method of historic assumptions. However, as per the Newton-Raphson's method, you can get the IV based on that particular premium. It's 13.06. This is the implied volatility. Based on this particular implied volatility of 13.06, your stock, the Nifty or the underlying, is expected to move 8367. Beyond this 8367, our uptrend will be set, and once this 8367 is crossing, it will make the targets at 8382, 8398, 8428, and maximum you can achieve during the day 8444 as per the WD GAN angle principle and with reference to this IV. So, and for this particular move you will have a Nifty downtrend which is starting at 8337. So this is recommending, this is the trend for the Nifty it has given you. Then the call options. Call option which 51 rupees and 80 paisa it was trading, and based on which you have calculated, it is telling you to buy the call option at 56 rupees and 10 paisa. Keep a stop loss of 43. When the Nifty will touch 8382, the call option will be trading at 61. When the Nifty will touch 8397, call option will be trading at 66. When the Nifty will touch 8428, call option will be 78. When the Nifty will touch 8444, it will be trading at 84 rupees. This is the outcome of this particular method. And this tool people are using from 2009 onwards. Many traders around the globe, they are using this particular tool from the 2009 onwards. And this is a tool based on the binomial option pricing model. Besides these things, besides your option premium info, it gives you the option Greek info also. So currently based on the premium of 51 rupees and 80 paisa, what is the last traded premium we have taken from the NSE site? Based on this particular premium of 51 rupees and 80 paisa, its delta is 0.3, gamma is 00125, and other Greeks are given here. Vega, gamma, theta. Vega means as per the volatility, how much decay in the time value we can expect. Delta means as per the premium underlying asset price movement, how much growth you can expect. Means if the Nifty goes up by 1%, this delta of 0.3 says that your premium will go up by 30%. So if every one day you passed on, your decay in the time value can happen. If each 1% fall in the volatility will bring 7% decay in the time value. Theta, this is the premium decay or the time value decay per day, which can happen as you proceed to the nearest to your expiry date. So this is the meaning of all this delta, theta, gamma and vega. So this is the currently as per this premium reference of 51 rupees 80 paisa, these are the info. When this premium will touch 84, the target for that time, what will be the delta, gamma, vega, theta, all those informations also you can get. Besides that, as per the WD Gann study, what is the buy sell decision of the underlying asset and what will be the resistances and supports, that information also you will get it. If downtrend starts at 8337, then it has the potentiality to go till 8230. If the uptrend starts at 8367, it has all potentiality to go to 8445 level. So this is how the buy sell decisions also you can get. Trends, resistances and support based on the Gann trendline method, that also you can get. You can get the option Greeks. So you can make use of this option Greeks in a very fantastic order also. Suppose if you want to form a delta neutral strategy, means net delta zero. Suppose if you are selling a Nifty future at the current price we have input at 8351, 8352, this is the price we have input on that. Suppose we are selling one lot of the future, so we have added a delta of -1. So each future having a delta +1 or -1. So we sold a future, so it is having -1. So currently the 8500 call option what we have analyzed, it is having the delta as 0.3. So if I can 0.3036, so if I can buy 3 lots of call option of 8500, this will become, my strategy will become delta neutral or delta zero, net delta zero. Suppose if it achieves the target of 8444 target, if it is achieving, so I have sold at 8352, so 8352 and it is achieving the last target 8444 it is achieving, and I have sold at 8352, so I will be incurring 92 points of loss on the future. How I will estimate this? So 92 points of loss in the future I sold, along with 8,500 call option 3 lots, and I have incurred a loss of 92 points if Nifty touches the fourth target as estimated by me. And same time, once it touches that fourth target, my option will be trading at 84.30. So I have bought at 52, 51.8. So 51.8, and it will be trading at 84, 84.3. So I'll be making 32.5 per lot. So in 3 lots of the options, I'll be making 3 lots of options, I'll be making 97.5 as a profit. So net if I can say, delta 0 I kept for this particular strategy. However, I'll be making a profit of some 5.5, means 5 rupees and 50 paisa as a net profit. So because I kept the delta as 0, means risk as 0. Similar way, if the Nifty fallen down in the downside direction, and it is touching this 8231 as per the downtrend confirmation. So I'll be having here 70 plus 50, so 120 points of profit I'll be making. So 150 will be my loss, means in the options I'll be having losses till 150. So 20 to 30 point I'll be making. So using this particular method also, you can have a delta neutral strategy. Though I have demonstrated a delta 0, but when the uptrend breakout, I always recommend you should have a plus delta strategy. That too also 30%, means plus 3 to minus 3, that range you have to keep. So your net delta should be plus 3. So if you can add one or two more lots in the 8,500, you could have converted it to plus 3 delta when the uptrend breakout gives. When the downtrend breakout gives, you have to keep the delta as minus 3, so then it will be rewarding. So if you keep the delta as 0, it may not be rewarding in case of a price move to the target 4. So if you keep it plus 3 plus 2 or minus 3 minus 2, then it will be rewarding. So you can utilize this particular tool in two different ways. One is you can do intraday trade. Second, you can utilize this particular tool for forming option strategies. One small example I have given for delta neutral. Similar way you can form the Vega neutral, theta neutral and all. So how it is different from our paid tool? Here you are punching all data, you are getting some values. However, the price points are changing. Price points, the moment you punch and the moment it is you are seeing on the screen, it changes. So those real-time implications on the implied volatility you may not get. Also, the implied volatility calculated here has limited accuracy because of its web interface, less calculations we can accommodate. So for that, it has a lesser accuracy. So the paid tool has a great difference, great difference. And paid tool, you can say it has many other features, like if you go for our SFIT, so Smart Finance paid tool SFIT. So this tool has a great feature for the option traders. Suppose if I am going for option here, suppose same Nifty I am choosing here, and I am just loading the data. So here, once I get those data loaded, I'll go for an analysis of the Nifty first. So what Nifty says that. So currently 8352 is the Nifty. This is the reference is being taken, 8352. Above 8374 my uptrend starts, below 8330 my downtrend starts, and my volatility of the Nifty is 19.76. Once this uptrend starts, it will go for 8385, 8394 and all these things it can give. So now I am at 8352. So 8352 means I am 21 points away from the uptrend and 22 points above the downtrend price. So this is how I can analyze. So whenever I will near to the uptrend price, that time I will choose to do the call option trade. Whenever I will near to the downtrend price, I am in the middle now. So when I will be nearing towards the downtrend price, that time I can choose for the put option. Suppose if I am doing a call option or put option, I just have to select here and the strikes will come. And if I just go for the strike, say 8500 strike and do analysis, my total outcomes will be different here. IV calculation, as I told you earlier, IV calculation you got only 10.35. However, in that manual edition you got at 15 because it has a limited inputs you have given. That's why limited accuracy you can get in that. So this is one big difference. And besides that, it gives you 59 rupees you can buy, 44 is your stop loss. These are the targets you can achieve. Delta, theta, gamma, vega, all these things in the uptrend, downtrend, you can get it. And you can also get some positional trades also. If you want to hold any position, this position for 5 days, so what are the moves you can get? So in the 5 days, if you are holding it, your first target you can get 70 rupees if it goes to 8435. And if it fallen down to 8269, your target will be 18 rupees. So based on positional trades also you can go. There is a other concept for arbitrage also, which are the options are highly priced or overvalued and which are the options are undervalued. So this also one automatic scanners you can get. So our 8500 actual premium is 51 rupees 60 paisa. It is trading. It should be trading at 61.74. So 10 rupees undervalue in call option. So this call option is 10 rupees undervalued, and put up this 8450 also 11 rupees undervalued. So whenever these options are undervalued, you will be getting this value in the negatives. When it is overvalued, you can get it in the positives. So by looking at this arbitrage opportunities, you can think of forming a strategy which can benefit you from this arbitrage. So based on the arbitrage also, you can able to make fantastic intraday gains and you can do fantastic arbitrage option strategies which can reward you with a time span of 3 to 5 days. So this is how you can utilize our paid tool. Paid tool has a great difference, as I told you, in terms of implied volatility calculation, in terms of trend forecast, everything. However, it has a greater accuracy also, improved accuracy, 80% above you can get it. However, if you do not have access to any kind of tool, you can still use this free tool which is available in our website. This too also give you a great accuracy. This too also will give you accurate calculations as for the delta, gamma, vega, everything. And you must use the manual before using this thing. You read through this manual link and then start using it. And it is a great tool, can be utilized for index options, stock options as well.